So let's start with a Fortune article. It just gives us an overview and how this is going to hit us as citizens. Many of us have different needs. This kind of covers it all. And the federal rate hike. So the Fed raises rates by another 75 basis points, how that can affect your money. And I'll go ahead and put this in the comments so people can check it out themselves.
Sure, and I'll just start by saying it was expected.
Yeah.
Anything other than that would have been a surprise.
Yep. I think the thing was, obviously, everyone was expecting, could it be one? Could it, instead of 75 basis points, could it be 100? And it wasn't. So that was some good news there. But let me roll through this super quick. On July 27th, the Federal Reserve announced another big rate hike, raising the federal funds rate by 75 basis points to a range of 2.25 to 2.5%. This move follows a 75 basis point hike in June and two smaller rate hikes at the March and May Federal Open Market Committee meetings, all part of the central bank's strategy to fight stubbornly high inflation. The Fed's decision today is not as aggressive as the 100 BPS increase that had been rumored for the FOMC's latest meeting, but it's more bold than the smaller hikes that started the year, indicating the Fed's desire to get inflation under control as soon as possible. The FOMC will meet three more times in 2022. Federal Reserve Chair Jerome Powell said in a press conference following the latest announcement that another unusually large rate hike could be appropriate at the next meeting in September. These rate hikes have been large and have come quickly, and it's likely that their full effect hasn't been felt by the economy, Powell said. There's probably significant additional tightening in the pipeline. So let me just jump over this because I know we have another couple articles to check out. So let me just cut to 4 ways the Fed rate increase can affect your money. So number 1, Fed rate increases affect the stock market, but not necessarily how you'd think. Fed rate increases have a pretty ambiguous impact on the stock market. On the one hand, higher rates may incentivize some investors to sell stocks and take profits. But there's plenty of evidence that over the long term, rate hikes don't hurt stocks. In the short term, the most significant immediate impact of rate increases is on market psychology. When the FOMC raises rates, professional traders might quickly sell stocks and move into more defensive investments without waiting for higher rates to work their way through the economy. But over the long term, the data shows that stock markets can rise in some cases when the Fed tightens monetary policy. Dow Jones Market Data analyzed the 5 most recent rate hike cycles to see what history says about stock market returns in these periods. Their analysis showed that during these 5 long-term periods, the 3 leading stock market indexes only declined during one rate hike cycle from June 1999 to January 2001 during the dot-com crash. Okay, so number 2.
So what happened? They hiked rates yesterday, and the stock market went up substantially 2 days in a row.
Right. So that's telling us what? It's already been kind of packaged in, not just mortgage rates.
It's been packaged in, and B, the Fed comments were leading towards the belief that they're getting inflation under control. And the stock market's always attempting to predict the future. It's not about the past for them. So those comments had a real impact on the market to the positive side.
Right. Number 2, credit card interest becomes more expensive. When the Fed raises interest rates, your credit card debt becomes more expensive. That's because the interest rates on consumer debt, like carrying a balance on a credit card, tend to move in lockstep with the Fed's rate. The Fed's interest rate policy impacts how much commercial banks charge each other for short-term loans. A higher Fed funds rate means more expensive borrowing costs, which can reduce demand among banks and other financial institutions to borrow money. Okay, so enough there.
Yeah. Yep.
Okay, and then number 3, mortgages and loans become costlier. Another Fed rate hike means that those borrowing to buy a house or to tap their current home equity could face bigger housing bill in the coming months. Shorter term home loans with floating rates like adjustable rate mortgages and home equity lines of credit are tied to the Fed funds rate. So when the Fed's rate rises, ARM and HELOC rates soon follow. With ARMs, there's an initial period when the rate is fixed before transitioning to an adjustable rate. However, due to the recent spike in the 30-year fixed mortgage rates, ARM rates have been lower and more attractive to some borrowers. The 30-year fixed rate mortgage averaged 5.54% compared to the average 5/1 ARM of 4.31% as of July 21st, according to Freddie Mac. Still, any action by the Fed to hike its rate will likely lead to higher ARM and HELOC rates. Any comments there?
We're going to show a chart about rates and the impact on the hikes, so I'll just hold off on that.
All right. And let's just finish up here. Number 4, rates on savings accounts rise but slowly. Rising Fed interest rates are a good omen for savers who are seeing the rates on savings accounts creep up. There's no direct link between the federal funds rate and deposit rates, but banks are slowly increasing the annual percentage yield they pay on deposit accounts, including savings accounts, money market accounts, and certificates of deposits. Financial institutions raise their rates to attract deposits, but they currently have plenty of cash on hand and can take their time with hiking yields. How quickly you'll see higher APYs on deposits depends on where you bank. Online banks, smaller banks, and credit unions typically offer more attractive yields than big banks and have generally been increasing rates faster because they have to compete more for deposits. So there's that. So yeah, let's go ahead and run over to that chart. And it's a real-time chart, isn't it, Darren? We're going to see where it is right now. Yeah, I love that. Okay. So this is looking at 30-year fixed mortgage rates. And you want to go ahead and summarize it a bit, Darren?
Sure. So on my end, Joe, you can click on that date, and I actually shortened the range. Right now it's 1 year.
Okay. What did you want?
I just shortened it to start at January 1, 2022.
All right. January 1, 2022. Where is it? 2022. Oops. January 1. Okay, there we go.
All right. So my reason for doing that is we're seeing the more recent movements a little better.
Right, including March and the run up. Yeah,
exactly. So from January, rates were in that 3% range starting the beginning of the year. They ran up in May to the mid 5s, moved back down. Then we had the previous 3-quarter bump, and that spiked. So this is the story we've been telling to all of our clients, both on the sell and the buy side. Just in preparation, we can give you history. We can't predict the future, but the most recent history from a couple months ago showed a spike when they did that 3-quarter bump.
Right. Here we are, June. Yeah, it's saying here 6.28. Yep.
Yeah. It moved up. It was substantial. It moved from like 5.5 to 6.25. It moved up that 3-quarter.
Right.
And almost immediately. But since then, it's been tapering down.
Yeah, look at that trend.
Right. So this is what there is not a direct correlation like there is on the commercial banks and savings rate isn't a direct correlation, but it isn't as direct. It's a little more loose. And since yesterday, if you scroll down a little bit there, Joe, you see the MND 30-year fixed rate daily.
Yeah.
To some of the text. So yesterday rates were 5.5. Today it's calling out rates at 5.2.
Wow.
So we had a three-quarter point bump on the Fed funds rate, and we had a 3/8 reduction almost on the 30-year mortgage rate. That's huge.
Yeah.
Not expected. Who knew? I will say this. There might be some more pressure, some more tightening to try to constrict a little more, because I think their attempt is to constrict the market a bit and slow it down. But in the end, this is having a positive effect on the real estate market, at least over a 2-day period.
Well, I was going to say, we can go into the Inman article, and that kind of finishes us out.
Sure.
Can we do that? Yeah.
Yeah.
So, this was here. Let me put mortgage. This is a great page. this Mortgage Daily News thing.
Yeah. I've been watching this for 15 years, man.
Yeah. Oh man, it's awesome. Yeah. Let me send this off to everyone. Let's see here. All right, there it goes. So 5.22. So what I'm going to next is Inman.com. Inman is a real estate industry resource for agents and brokerages. And the title of this one is "The Fed's Steady Approach to Rate Hikes Could Ease Pressure on Mortgages." Fed Chairman Jerome Powell hinted Wednesday that the U.S. Central Bank is looking to dial back the pace of interest rates hikes as soon as the impact of increases shows up in inflation data. Excuse me. So let's see here. I do have an account. I don't know why I'm not signed in.
And that's the news that made everything turn positive. The belief that it's already having an impact. It takes some time for it to show up in the numbers, but he believes it's impactful already. And that's what's I'm assuming the rate drop is triggered from, but certainly the stock market rise has been triggered from that.
Okay, here we are. In a move that could take some pressure off of mortgage rates, Federal Reserve policymakers voted Wednesday to raise short-term interest rates by the same amount as they did last month, instead of taking even more drastic measures to fight inflation. The 75 basis point increase in the short-term federal funds rate approved last month was the biggest rate increase since 1994. But because there are signs that inflation continues to rage unchecked, some analysts had speculated that the Fed might make an even more aggressive move in July and approve a full 1 percentage point rate hike. By sticking with another 75 basis point increase that was already priced in by bond market investors, the Fed has staked out a middle ground that's designed to communicate that policymakers are still concerned about inflation, but don't want to slam the brakes too hard on economic growth. Marty Green of law firm Polinsky Vidal Green said some of his firm's mortgage lending clients are anticipating, quote, a slight improvement in mortgage interest rates in response to the Fed's actions, particularly after the recent speculation that the Fed might raise rates in July a full percentage point. Rates on 10-year Treasury bonds, a good indicator of where mortgage rates could be headed next, fell below 2.75% after the Fed's announcement, down from a 52-week high of 3.48% on June 14th. Wow. Mike Fratantoni, chief economist for the Mortgage Bankers Association, noted that mortgage rates have already dropped about a half a percentage point in recent weeks, heading closer to 5.5% than the 6% rate seen in June. There is a tug of war in market expectations between the persistently high inflation numbers and resulting rapid Fed hikes and the increasing risk of a sharp slowdown and possible recession, Fratantoni said in a statement provided to Inman. As a result, mortgage rates may have already peaked and could stay between 5% and 5.5% through the remainder of 2022. If that were to be the case, potential buyers who had been scared off by the rate spike might find their way back to the housing market. So, shows here mortgage rates ease. Let's see, this is back to June 28th, it looks like, to now. So, yeah, pretty steady over the last 30 days. Nothing crazy. Since more than doubling from historic pandemic-induced lows, rates for 30-year fixed-rate loans have eased somewhat from a 2022 high of 6.06%, registered June 14th by Optimal Blue Mortgage Market Indices. Oops. More advertising. Despite that, the demand for purchase mortgages was down 18% last week when compared to a year ago, according to a weekly survey by the Mortgage Bankers Association. The question is whether the slowdown is a result of most consumers simply pausing a purchase decision while they see where interest rate and home prices settle, or whether they are having to delay a purchase decision indefinitely because of affordability concerns, Green said in a statement to Inman. In a statement on their unanimous decision to raise the federal funds rate by 75 basis points, Fed policymakers said they remain strongly committed to returning inflation to its 2% objective. And what are we at now, Darren? 9 or 8?
Yeah. The last one was like 9.1 or something. Yeah, but that's
Uh,
a year over year. I mean, that's yeah. It's always looking towards the past, and they're comparing it over time. So again, all the numbers from the Fed and the data they provide is always about the past. So
yeah,
they having to make their own predictions on their policy and how it will impact the present, and
right.
then they have to wait until time passes to determine if it did.
Yeah,
So
yeah. Well, right. You went out 2 days. Yeah, these guys are going out into the fall, so that's nice to see.
right,
And maybe they
right,
know a little more. We'll see.
yeah, they
Um,
do for sure.
yeah. So that was the gist of it, basically. But yeah. So what does this mean, Darren? If you're a buyer right now, what does this mean if you're a seller, possibly right now? What sort of choices? What kind of thinking should they be?
Well, so if you're a seller, it's clearly good news because
Right.
it maintains affordability a little
Right.
more. I mean, when the numbers go up dramatically on the interest rates, affordability drops, and buyers just leave. Buyers
Mm-hmm.
have obviously been dealing with rising prices for a long time, and now those are easing. They're
Right.
they're they're still considered to be rising, but at a slower pace. Some are dropping, but rising at a lower pace or stagnant is kind of where we're at. But this allows that to level off rather than go in reverse, I believe.
Yeah.
So from a seller perspective, this is good. And now it's psychology of the buyers. What's their
Right.
position? How are they going to feel about the market? Is this enough to get them to jump back in? This is one of those little, there's always a series of little waves, ups and downs.
Yeah.
We spoke about that. We were in a little lull as we were waiting and anticipating this most recent hike after the spike in rates from the last hike.
Right.
And that very well could have just been a buying opportunity. I think a lot of buyers stood on the side, some jumped in.
Yeah.
If the rates stay down, if they stay in that below 5.5 range,
Yeah.
I think we're going to get buyers jumping back in again,
Yeah.
and it's going to be positive for
Well, as
values.
as the article stated, right, on the buyer side, there are ones that kind of waiting it out. Yeah, let's see if the
Yeah,
prices go down. Let's see if mortgage rates go down a little bit more.
yeah,
And then there are ones that just can't afford, and it's really hitting them hard. So as we've said before, certainly there may be less buyers in this market, and for a seller, all they really should be concerned about is if they have two offers, right? We talk about that.
right. So I would say this year we've seen that
Yeah.
certainly, maybe starting February. We went from a crazy number of offers to still multiple offers, but not the
Right.
volume that we were seeing in the past.
Right.
And in some cases, now that isn't the case. You're definitely seeing some price reductions. It's a little more balanced, but the volume is down across the board,
Hmm.
even on great properties, unless they're, we will go through an evaluation of solds and actives. And no, if it's ridiculous, if it's way underpriced, the volume will be
Right.
up. You'll get a lot of people, you'll get a ton of offers.
Right.
But if it's in the range of market value, then it's not the number of offers isn't as high.
Right.
So from a buyer perspective, it's positive because affordability is getting a little better,
Right.
right? It may mean an increase in prices or stabilizing prices without a reverse, which some buyers hope for. But it does mean that they can afford more.
Great.
So that's a plus.
Okay. So a little bit of a plateau here. We'll see what September brings us. I don't know the date, but yeah, right. That'll be our next report, I guess.
Yep.
But this stuff changes week by week. So I know we're
Sure.
going to talk about it ourselves every week.